Welcome to the 1031 Exchange Passive Income and Investment Series. This show is brought to you by 1031navigator.com. 1031 Navigator is the best way to plan, execute, and complete your 1031 exchange with peace of mind and confidence while saving you both time and money.
Hey everybody, Thomas Morgan here with 1031navigator.com and also Compound Global. And today we're doing a joint episode for both different podcasts I run. And we're going to cover some 1031 exchange topics, of course, triple net property topics, but also opportunity zone and impact investing topics. And my guest today is Tony Nitti. And Tony is a tax partner with RubinBrown based out of Aspen, Colorado. He's a CPA. Tony specializes in corporate and partnership taxation with an emphasis on complex mergers and acquisitions. Tony is a regular Forbes contributor. He's been quoted on Bloomberg and CNN Money, and he also writes for Tax Advisor. One of his most recent articles was called Switching from S to C Corporations, How You Do It Could Save or Cost You Millions of Dollars. And Tony likes to get into the weeds on different tax topics, and some of his most popular posts from last year were the top tax court cases of the year. And Tony, I don't want to knock CPAs, but I deal with them on a regular basis, and a lot of times they're very dry. And a lot of times they don't take responsibility. They say, well, I'll have to check the tax code. And I just want to say, I admire your enthusiasm. It's contagious, and your depth and breadth are immense, and your ability to get into the weeds, but also still keep it kind of light is a unique skill set. So thanks for being on the show.
Oh, thanks so much for having me, Thomas. Yeah, it's one of those things where, you know, if you didn't laugh, you'd cry, right? If you make your living in the tax law, you have to try to approach it with some semblance of a sense of humor, because this is a tough topic. I mean, the tax law is among the more convoluted areas of law in this country, and it's only getting more convoluted by the day. And so I'm doing the best I can. Like you said, I like to get into the weeds, and, you know, that opportunity to get into the weeds has only grown exponentially since we basically kind of overhauled everything about a year ago. So again, thanks for having me. Thanks for the kind words. And let's see if I can live up to the introduction that you provided.
Yeah, no, and I also appreciate your how succinct you are. You know, we met back in December, and
sure,
you're very good at using the right word. And I think the listeners will be able to hear when we talk about opportunity zones in particular, about the different terminology. When you say a word, you're referencing the actual tax code. And so you make it very clear, where us more, general practitioners, we might say one word, and you're very good at calling people out, or feel free to call me out if I'm using too general of a word on these different examples.
Well, sure. Particularly as we get into opportunity zones, one of the things that's so frustrating about that new incentive is that one word can make a big difference. We have all these new terms of art, these critical definitions, and yet sometimes they differ by one word. So, it's easy to say sometimes we don't have to pay attention to details when we're providing a term or using a term, but in tax law, it's just so important because, one word, particularly, like I said, in the opportunity zone space, could make a huge difference.
And like you said in your article, it could cost you millions of dollars or hundreds of thousands of dollars if someone makes an error with that word.
Yeah, absolutely. Wrong word, wrong method of conversion, whatever it may be, wrong structure for your investment. The consequences are huge. I mean, as the tax court's judges always like to say, the beauty of our tax law is you're free to structure your transactions however you see fit, but you do have to live with the consequences. So, if you go wrong, it can go sideways pretty fast.
And on your Forbes articles or your Tax Advisor articles, what have been the most kind of popular or even maybe most controversial, or where do you get the most kind of feedback and comments or reads?
Well, that's interesting. I break it into two parts. Number one, I cover a lot about tax policy. So proposed legislation, particularly obviously when the new law came down, but even now covering some of the Democratic candidates for 2020, their tax proposals. And when you're covering tax policy, inherently you're talking about politics. Even if you're not trying to take a position on one side of the fence or the other, the readers, are going to glean from your position on a tax policy, whatever they want to glean in terms of what they think it means about your politics. And as you may have noticed, we're fairly divided as a nation right now. So
right.
If you start writing about tax policy and you say, Bernie Sanders may raise the estate tax rate to 77%, even if you just state it as succinctly as that and don't say you approve it or disapprove it, whatever it may be, in the comments section, you'll have readers on the right, going after you and saying acting like it was your idea.
Right.
And then the opposite is true as well. If you, praise any aspect of the Tax Cuts and Jobs Act, you'll have readers on the left telling you it was a scam and a giveaway to the richest 1% in corporations, even though there's plenty of empirical evidence to suggest that, everybody is going to enjoy, or not everybody, but as you get above, say, $50,000 of income, everybody was going to enjoy a tax cut for the most part in 2018. But, like I said, when you cover tax policy, the only way you can know you're doing it well is if both sides are equally angry, right? Because people are going to get angry no matter how you shake it. As long as it's coming from both sides, that means you're towing the line. So it's always fascinating for me to write about tax policy because, like I said, other than, maybe guns and religion, it's what people are most passionate about politically in this country. And then in terms of general tax writing about the existing law, I kind of accepted my fate several years ago because I carved out a niche in Forbes really doing exactly what you mentioned in the intro, right? Like I will get into the weeds about a tax topic. I will write 13,000 words about a new area of the tax law that has interest. And that is obviously very contrary to what we know now about internet publishing, right? I mean, the average article you read is probably 700-800 words. So you put up a 13,000 word missive and, people are going to say thanks, but no thanks. But
right.
What I have found that's interesting is, I'm not really writing my tax articles for the casual reader who wants to know how to check on the status of the refund. I am writing for people like your listeners who are like, hey, I know a bit about 1031 exchanges or opportunity zones, but I want to understand more, but I want to understand it. I want to read it in a way that, kind of sounds like English. Like I can open up the tax law just like anybody else, but can't make heads or tails of what I'm reading. And so it's interesting. I'll publish sometimes one of these, really long, in-depth articles, knowing full well that nobody's going to stop what they're doing once it publishes and say, oh, I gotta read this right away. But there will come a point in time in most accountants' lives, in a lot of investors' lives, in the case of opportunity zones, where they will need that article and they'll go to their Google machine and they'll put in the right search terms and it'll pull up my article. And, that's when it becomes very useful to them. So it's kind of interesting. We live in a quick fix, instant gratification society, but a lot of my writing is really done more for the long term, to provide as much depth and background as people need, knowing that they may not need it tomorrow, but they will need it at some point. And so that's kind of been interesting as I try to really beat up the new tax law and make some sense of it.
Yeah, and like I tell my clients, I always check with your tax advisor or tax attorney, whatnot. Everybody's situation is different based on how long they've held the property, what other kind of investments they have, where their net worth is, their income sources. So you can't just, have a little magic calculator that says this is, where they are and this is what they're going to pay. It's a more nuanced, advisory role. I feel like in the tax business.
Well, not only is it nuanced, for the reason that you just pointed out, right? That everybody's facts could be subtly different and that could change things dramatically. It's also nuanced because the tax law is always in flux, right? It's always changing. Mm-hmm. And you can't imagine how much it's equal parts flattering and terrifying when, I'll go speak somewhere or someone will email me and they'll say, I keep this article you wrote, I keep it printed at my desk and I use it as a resource. And I think to myself, that's nice, but I wrote that article in 2014,
right.
You got to buyer beware, because that's 2014. A lot happens in 5 years in the tax law. We have new guidance, we have new, court opinions. And so you're right. I mean, trying to write about the tax law, trying to advise about the tax law, it really requires, one, understanding a client's specific set of facts, and then two, understanding not only where we stand today in the tax law, but I think this is more important now than ever, and we'll probably get into it at some point in our conversation, understanding where the tax law is headed, because we are in as tenuous a tax environment right now as we've probably been any time in the last century. And so that has to come into long-term planning. So, I mean, today, your two topics that you thrive on are perfect examples. Like-kind exchanges, right? Opportunity zones. I mean, they're both built on the foundation of deferral of gain. But when you're deferring gain, right? I mean, the gain eventually, in most cases, certainly in opportunity zone cases, will come home to roost. And you have to ask yourself, when the tax landscape is as volatile as it is now, what will the tax rate be that I'm deferring this gain into?
Right.
And so that's what makes it so tricky to be a tax advisor right now. It's not enough to know the current law. You really do have to have an inkling of where the law may be headed.
And on 1031 exchanges, for example, that's one of the oldest pieces of deferral, from what I know. And it was pretty much on the chopping block. In the last election cycle, people were saying we're going to get rid of it, and luckily they didn't. But the opportunity zone legislation is the same way. And if they repealed the Jobs and Tax Cut Act, would the opportunity zone legislation go away? And that's something to consider, I feel like.
Sure. I mean, as I said, the Tax Cuts and Jobs Act, let's make one thing clear, right? For good, bad, no matter what you think about it, there's no denying this was a Republican tax bill, right? It was written only by Republicans. It was voted for only by Republicans. Democrats had no involvement. And that's fine. Republicans had every right to do that. But what that means, of course, is that this bill is only as permanent as Republican control. And so, yes, if in 2020, we end up with a Democrat in the White House and maybe Democrats taking back the Senate, we could see material changes to so many aspects of the new tax law. However, if you were to tell me, pick one provision that you think would absolutely survive a change in control, I would say it would be the opportunity zone incentive. And that's because it really is probably the sole provision in the Tax Cuts and Jobs Act that had bipartisan support, and just the nature of the program, and that it has kind of this one timeline as we run through from 2018 to 2028. I think that we don't have to worry about the rug being pulled out from under us at all for any investments we may be making now. I think the bigger questions with opportunity zones, really, there's two of them. Number one, is it possible that this would come around for a second go round? Or number two, like I said, opportunity zones may stay in place, but one of the prime carrots that's dangled in front of an investor in an opportunity zone is what? Deferral of gain into 2026. What we don't know is what, Democrats, if they take back the White House and the Senate, what they would do to that capital gains rate. So we may still have this opportunity zone incentive when 2026 comes around for certain, but we may have a top capital gains rate that is no longer 23.8%. It could be 52% under, what Bernie Sanders had proposed back in 2016, or
sure,
who knows, it could be higher, given some of the proposals that have been floated around and that are actually very popular among voters. So, yeah, I don't think O-zones are a threat to go anywhere, but their benefit could certainly be dulled if, sweeping changes are made to tax rates as we go into the future.
And with the 1031 exchange being around for as long as it has been, and with so many people taking advantage of it, do you think that would ever seriously be on the chopping block, or do you think that's kind of just a de facto part of our tax code?
Well, I would think that if it survived the most recent round, even though, again, those were Republicans conducting that round, if it's survived that round, I think it's pretty safe for a while, because the reason 1031 was potentially on the chopping block is because you have to pay in at least part for some of these tax cuts. So this most recent tax bill cost on paper, and we're finding out it's going to cost quite a bit more, but on paper it's going to cost $1.5 trillion over 10 years. So that's $1.5 trillion of additional deficit. And so to try to keep that number even at 1.5, which has been heavily criticized, they had to raise some revenue from some places. And one of the ways they chose to do that was, okay, let's not kill off 1031 in its entirety, but rather let's kill off everything but real property exchanges. So we don't have personal property like-kind exchanges anymore, but we do still have real property. And so I would just think the next round of tax reform, if they need to raise revenue, there are other ways, for example, Democrats would go about it than necessarily attacking Section 1031. They, can certainly raise the corporate rate, and they're likely to do so. They absolutely will raise the top individual rates, certainly could raise the top capital gains rate on individuals. And so I think 1031 is safe. It's been such a, storied part of our tax law. The only thing that's concerning is, again, what Democrats are kind of going to build their tax platform on is the concept that the Tax Cuts and Jobs Act was a giveaway to the richest 1% and corporations. And so if the Democrats take back control, they know that any tax changes they make that are perceived to increase the tax burden on the richest 1% will probably be well received. And I do believe there's an element to that with 1031 exchanges where people tend to think it is the strictly a tool of wealthy real estate investors. And I think a lot of Democrats in policy, for example, directly correlate 1031 exchanges with the man in the White House right now as something he would use to cut taxes. And so once that correlation is made, it can be an easy sell to say to voters and constituents, well, we're going to cut middle class taxes, and one of the ways we're going to pay for it is we're going to get rid of these like-kind exchanges that rich real estate investors use. And I think that would be politically palatable, but we can't ignore the fact that the underlying law for a 1031 exchange makes sense. And what I mean by makes sense is like, hey, if you swap a building for another building of equal value, right, you're not really liquidating your investment. You don't have any cash in hand to pay a tax bill, right? You're just continuing your investment in a different form. Right. No different than if you swap your stock in a corporation that you founded, and you sell it, so to speak, to another corporation in exchange for their stock, right? You haven't cashed out. You've simply changed the form of your investment. And so even though 1031, I guess, could be used as a political chess piece, the reality is there's a reason it's in the law other than just a giveaway to businesses and to individuals, right? It's there because it makes sense. You generally don't want to kind of foist a huge tax burden upon someone when they don't have any cash from the transaction to pay the tax bill. So I think 1031 in the real estate universe will be around for a long time, but who knows, right? Like I said, the biggest takeaway we can have from this discussion is that we don't know anything about what the tax law is going to look like in as short as 24 months.
Right. Yeah. Red or blue. My clients are both or in between, and myself and others have referred to the 1031 exchange as one of the greatest wealth building secrets known to mankind. And I was just curious as to what you think about that statement, and if you think there's other provisions that are better than the 1031, or if you think the 1031 is that golden goose.
No, I would agree with you. Listen, right? It comes with a price to pay at the end, but there is no better tax planning strategy than to hold appreciated real estate, to continue to do 1031 exchanges for that real estate throughout your life rather than dispose of it and have a big tax hit. And then at some point, go on to meet your maker, and because your heirs will then take that property with a stepped up basis, with that gain never having been recognized. And so, yes, I mean, 1031s have been an integral part of high-end tax planning for a long time, because again, if done throughout one's life, and then you ultimately pass it on to your heirs upon death, you avoid gain forever. And there's not many areas of the tax law where you get to avoid gain forever.
In the biggest aspect that I look at with my clients is, on the income real estate, is if you have large gains that you can keep deferring, you keep reinvesting, you get income on those gains, rather than, I say poof, you pay the tax collector, the money goes bye-bye. But if you can keep reinvesting that gain and get the income, it just increases your overall yield and your overall wealth building strategy.
Absolutely. You're 100% correct.
With your day-to-day practice, or people you've seen, what are the common misconceptions you see people have about a 1031 exchange?
Well, the first thing that jumps off the page, and this may not be what a lot of people first think of, but again, maybe I'm just inherently a pessimist, but I think a common misconception is that deferral is always the right choice, right? If you can do a 1031 exchange, do a 1031 exchange. And listen, deferral is very, very often the right choice, but you do have to remember that there are situations in life where sometimes it behooves you to just get your cash, pay your tax, and move on, to your next aspect of life. And again, you have to look at kind of where you are in your life and the position and what you want to do next. But deferral, as we just kind of alluded to before, you can continue deferral on to death and then avoid that gain forever. But if this gain's going to somehow or at some point come home to roost, you do have to constantly keep an eye on, what am I deferring into? What will the rate be when this gain eventually becomes an issue? And, how long do I want to continue to hold real estate? And if at some point I just simply want to take my cash and retire to an island somewhere, could you have done that several years earlier at a lower tax rate? And so that's kind of one of the big misconceptions, is that, so many people are determined to chase deferral. But again, not to say that it's not very attractive, but it's not always the right move for somebody. Sometimes you just want to, like I said, pay your tax.
Yeah, and that's a question. I kind of joke. It's like a Shakespeare quote: to do or not to do a 1031, and we use different like a spreadsheet analysis, and it really seems like it comes down to, one, how low your basis is, two, and also what reinvestment rate you're going into, and then along with that, your tax rate in the future. But it seems, in my experience, if the shorter you've held the property or the higher your basis, it makes sense to just go ahead and pay your tax now.
Yep.
And, step up the basis and then reinvest, and then you don't have that looming tax deficit. You don't just keep compiling a deferred tax liability, because you step it up. Correct?
Agree. Yeah, absolutely. I mean, the one thing I would add to that, though, is, if you've got low basis, it's certainly going to kind of be a sticker shock when you look at what the tax liability would be on a taxable disposition. But the one thing that, a spreadsheet can't tell you is just simply, where are you in life? Like, do you just want to be done? Do you want to be done? Everybody reaches that point at some point where they just want to be done, managing real estate, or just dealing with some of the headaches that come with it. And again, this isn't something that happens all the time, but there are just times in a taxpayer's life cycle where they say, you know what, I'm ready to have my cash and move on. And if you just constantly think that deferral is, kind of almost mandatory, you sometimes can miss the boat on that. But yeah, I would agree with you. If basis is still high and values, are such that selling it in a taxable transaction wouldn't be that painful, and tax rates are low. And the one thing we can be sure of, Thomas, is that rates from a capital gain perspective will never be lower than they are right now. And how can I be sure of that? Well, because, they just, the Republicans just had their shot, right? Once in a 31-year opportunity to redesign the tax law however they see fit. And they chose to take that capital gains rate and leave it alone. So it's 15% for most people, 20% for the wealthiest taxpayers. And so if the Republicans did not take that rate down, you can bet that no one else is taking it down. So that's just something you have to keep in the back of your mind, is that this is as low as rates are going to get. So, sometimes, like we've already said, but sometimes you just want to pay the tax bill and move on with your life.
And like you said, the government still has to make up for revenue somewhere. So and that's one of the ways they can do that. They can't dip it too low or they lose their revenue source.
Yeah, but what we could see soon here, Thomas, is the opposite. If Democrats take back the White House and the Senate, that capital gains rate on individuals, for the wealthiest individuals, could really go all the way to the point where it matches the ordinary income rate. And the reason I think we're in a perfect environment for that to happen is because this latest round of tax reform, it's the first time we've had tax reform in the social media era. And what's fascinating about that is this narrative was created on social media that the Tax Cuts and Jobs Act was what I referenced before, that it was a giveaway only to the richest 1% and to big corporations. And again, the numbers don't really bear that out, but the numbers aren't great either. But the point is, people believe it. And I say they believe it because the Tax Cuts and Jobs Act in 2018 gave a cut to 9 out of 10 taxpayers with income greater than $40,000. Yet, this bill has topped out at around 39% popularity. And that's because human nature, right? People say, hey, even if I got a tax cut, if my wealthier neighbor down the street got a bigger tax cut, then I'm not happy. And so people are upset. People think that, the richest 1% got a huge windfall here. And so if you're a Democratic candidate, right, the easiest sell right now, the easiest sell to voters is, hey, if I, you vote for me, I get elected, I am going to cut middle-class taxes and pay for it by jacking up taxes on the richest 1%. And those proposals are extremely popular. When AOC informally floated the idea of moving to a 70% top ordinary income rate and potentially a 70% top capital gains rate for those wealthiest taxpayers, that proposal itself had a 60% popularity. That just goes to show you, right, that people think there's a huge wealth divide in this country, and they don't mind jacking up taxes on the richest 1%, because for 99% of people, that's not you. And so, yeah, we could absolutely end up in a situation here sooner than we realize, where the top rate could go from 20%, 23.8 after accounting for Obamacare taxes, up to something we haven't seen in the longest time, if not forever. It could be, like I said, Bernie Sanders ran in 2016 on the idea of a 52% top capital gains rate. So it is tenuous times right now, and it could have a significant impact as we try to do forecasting.
And so, this question depends on obviously what the estate tax would be and what the capital gains tax would be in the future. But for a family who has owned property for 20, 30, even 40 years, and they've continually done 1031 exchanges, is there a point where, Tony, they right before, or they think someone's getting at the end of their life, is there a point where they should think about selling that, or does it make sense just to let it run out and be settled in the estate?
Yeah, as you just said, with the big caveat that huge changes could be coming to estate taxes as well, because once again, public perception is that is a tax that only applies to the wealthiest 0.2% of Americans, and that is factually correct. But because of that perception, big changes could be coming to the estate tax as well. with that caveat that we don't know what's going to happen on the estate tax side, I would tell you kind of the opposite, right? If you make it through a long life and you hold this appreciated property with significant deferred gain at a time where, you're almost kind of ready to head towards the light, you're better off probably, just continuing to hold it at this point, because as of now, tax-free step-up upon death is still in place. And that is ultimately, we say it all the time, but it's ultimately the greatest tax planning tool that there is. And so, that's something that could be on the chopping block. Strangely enough, a lot of candidates don't talk about it. They talk about raising the estate tax rate and lowering the exemption, but not enough talk about doing away with the step-up that the heirs receive tax-free. Oddly enough, really, the last politician to talk about it as a big part of the proposal was Donald Trump. I mean, he actually proposed that as a candidate. Now, obviously, that never came to fruition, but as long as that tax-free step-up is still in place, if you're anywhere kind of in the twilight years of your life holding appreciated assets, yes, there's going to be tremendous motivation at that point not to liquidate, not to trigger a tax bill, because you're so close to the ultimate cap.
And then the heirs at that point, after death and after the estate is settled, they get the stepped up basis, and then they could go sell the property, and their tax bill would be very low or almost nil. Correct?
Nil if they sold it. Yeah.
Yeah. Okay. On we talked about misconceptions. My clients are, people are always surprised when their accountant tells them what their tax bill is going to be. They say, I'm selling this property for $4 million. And so they go to their CPA and they say, what's my tax bill going to be? And their accountant comes back and says it's going to be $1 million. And they're like, wait a minute. I thought my tax bill was only going to be like 500,000 on just on the gain. What goes in, I know what goes into it, but, a lot of people don't understand what recapture is and how that gain is calculated and how that tax bill is calculated. Can you go over that real quickly?
Yeah. So, there's all kinds of hidden little tweaks in the tax law, but sure, you just referenced kind of selling a building for $4 million of gain. And let's just assume for our purposes that we had purchased that building for $3 million several years ago. I guess that's probably a bad example. We wouldn't have gotten much appreciation. Let's say we bought the thing for $1 million.
And that's more where most of my 1031 clients come from, is they have a almost zero basis or very little basis. Yeah. So,
yep. So let's say we bought this thing for $1 million, darn near 4 decades ago, and we depreciated it. We took depreciation deductions where that $1 million went all the way down to zero. And now we sell the building for $4 million. Well, again, common misconception is, hey, we got $4 million of gain, taxed at capital gains rates. And so, capital gains rates are 20%. And so I'll just kind of compute my estimated tax based off of that. Well, what you have to understand is when you took those depreciation deductions for that $1 million of basis that you purchased, you got ordinary deductions for those. Those offset your income, kind of dollar for dollar. And so what they force you to do, and it's actually kind of taxpayer friendly with real estate, because in other walks of life, for example, if you're to sell, equipment or furniture, what they say is to the extent that your $4 million of gain is attributable to prior depreciation deductions that you claimed, which in our case would be $1 million, right? You have to pay tax on that in the real estate context. That depreciation, it's what we call unrecaptured Section 1250 gain from a tax parlance perspective. But that $1 million of depreciation that's part of that $4 million of gain actually gets taxed at a 25% rate. And so that element of recapture hurts right away. So you've got 25% gain on $1 million, you've got 20% on the remaining $3 million, but then, there's other, tweaks as well. I mean, starting in 2013, We have the net investment income tax, right, as part of the Obamacare provisions. And while some people think Obamacare has been stricken from the law, that's not the case. And so there is still an additional 3.8% surtax in a lot of situations when somebody disposes of appreciated property. And so, that rate starts to climb up now to 23.8% on $3 million of the gain and 28.8% on the remaining $1 million of gain. And that's before you acknowledge state tax implications.
Right.
And so, the bill can start to skyrocket pretty fast.
I'm just doing the math on that real quick. So in that example, that if they thought their tax liability was just going to be on, let's say, their $3 million gain, maybe they were thinking like $500,000, $600,000, but that right there, not including state income taxes, would be $940,000. Capital gains plus Obamacare plus recapture in that example, and people are always surprised when they hear those numbers.
Yeah, I mean, it's why you got to have an advisor crunching numbers for you that understands all aspects of the law and actually takes the time to do the math, because sometimes advisors fall into that same trap. They just take the gain multiplied by the capital gains rate and forget all the other ancillary potential increases to that tax rate.
And so if you were to just use like a rule of thumb, if someone says, look, I'm selling this property and this is what my basis is, what would you use? Would you use 25% or 30%?
The first thing I'd say is, are you located in the states of California, New York, or New Jersey?
Right.
Because if you are, right, I mean, we're talking state rates in double digits, right, or close to them. And so that's a whole different animal. But for the other 47 states, I mean, to be conservative, if you're blending federal and state together, particularly now that state taxes, are not deductible on a federal individual return, right? So there's not even that additional benefit. I think that if you're comfortable that the Obamacare taxes apply, using a blended rate of 28 to 30% is probably a touch conservative, but being a touch conservative is usually a lot better than being underpaid.
Sure. And like, it goes back to your point earlier, Tony, about when in doubt, or usually the best option is to just defer, and then you don't have to even worry about the capital gains tax for the time being. Yeah,
you're absolutely right.
Okay,
and as long as you don't think you're going to get pressed into a situation where you can no longer defer in a number of years, and the rate might be significantly higher.
And so another thing that came out of the Tax Cut and Jobs Act was Section 199A, or what do you call it? The 20% deferral or 20% deduction.
20% deduction against pass-through income. Yes.
And so for net lease investors, like true absolute net lease properties, the landlord doesn't really have to do anything. Maybe pay a tax bill and then get reimbursed by the tenant. But then you have double net or single net leases where the landlord's going to be a little bit more involved, might have to get the roof repaired or the parking lot repaired. And, then on the other end of the spectrum is like a office lease, gross or modified gross lease, where the landlord's going to be a lot involved and maybe have a management company do certain things. I've heard people say, and I think we touched on it in one of our conversations a few months ago, was that if you solely own absolute net properties or even double net properties, you're not going to be able to qualify for that 199A deduction. Is that correct? Or what's kind of the background, and what I think something passed in January that also clarified that?
Yeah, let's talk about that for a second. First things first, this 199A deduction, right? 30-second high level, why does it exist? The hallmark of the Tax Cuts and Jobs Act, no matter how it might have been sold to the public, was they cut the corporate rate, right, from 35% to 21%. So big corporations, Amazon, Facebook, whatever it may be, they're not paying a 35% rate anymore at the corporate level. They're paying a 21% rate. However, most businesses in America don't do business as corporations, right? Mm-hmm. Because they don't want to pay a double level of tax, once at the corporate level, once at the shareholder level, when earnings are distributed. And so most businesses, and what we consider small business or Main Street businesses, are set up as what we call pass-through entities, partnerships, S corporations, where if the business recognizes income, the business generally does not pay tax on that income. Instead, the income is chopped up, allocated among the owners, and it's the owners who pay tax on the income. And so what happens is the owners pay the tax on the income in these flow-through businesses at individual rates. But in the Tax Cuts and Jobs Act, the corporate rate was slashed from 35% to 21%. That's a 40% reduction. But the individual rate, the top rate, simply went down from 39.6 to 37%. And so what that does is it just screws up the whole relationship between corporations and pass-through businesses, where previously pass-through businesses had about a 10% tax rate advantage over shareholders in a C Corp. And now all of a sudden, through no fault of their own, right, Congress pulls the rug out from under them, and that differential shrinks to almost zero. And so what Congress did to prevent that differential from shrinking to zero is literally just create out of thin air, right, a new deduction that owners of pass-through businesses, so if you're a sole proprietor, you're a partner in a partnership, you're a shareholder in an S Corp, you can claim a 20% deduction against the income earned in your business. Why? Because that means your top rate on that income isn't really 37%. It's 80% of 37%, or 29.6. And what that effectively does is keep you with a relative right about 10% advantage over, the Mark Zuckerbergs of the world that operate their businesses as C Corps. So the deduction was simply, again, there was no underlying policy or economic reason for it other than, hey, we gave big benefits to corporate owners, we better do something for everyone else too. And the problem when you just create law for no great reason is now you have to, provide rules and guidance about that. And so we've gotten several hundred pages of clarification of how this 20% deduction works. I can tell you, from someone who makes a living in the tax law and, prepares and reviews returns as well, it is the bane of every CPA's existence right now, because it applies on a broad scale, but yet is very, very hard to understand. But what you're getting at is kind of a overarching theme where you can only take this 20% deduction if the income is earned in what we call in tax parlance a Section 162 trade or business. And what that really means, it's not defined anywhere in the code and regs, but it's defined in the Supreme Court by a case called Grotzinger as being, look, you can't be engaged in this activity sporadically or for amusement or whatever it may be. You have to be engaged in this venture that you're in with the motive of making a profit, and you have to conduct the business, with regularity and continuity. And so for most businesses, it's not too hard to figure out that, you're trying to make a profit. Whether an activity rises to the level of a business has become really kind of muddied over the last century is with rental activities. And we got a lot of relief where, we now have a new safe harbor where for most rentals, if we can show, it takes 250 hours every year to kind of keep that rental going. And the 250 hours doesn't have to be by you, the owner. It can be by you, the owner, plus any employees, plus any independent contractors. But if you spend those 250 hours, then you can satisfy this safe harbor that just says, my rental is a trade or business, no problem. I can take a deduction of 20% of the income. The problem is we can't use that safe harbor against income that's generated from property that's rented, as you alluded to, on a triple net basis. And this just harkens back to the fact that for the last 30 years, the IRS has looked at property rented on a triple net basis where the tenant is on the hook for the real estate taxes, insurance, and maintenance as really being more akin to an investment by the owner of the property than engaging in a business. Because the tenant's the one that bears all the responsibility, right, if something goes wrong. And so we don't have a lot of guidance, but for the last 50 years, the IRS has made clear their position that if you rent property on a triple net basis, you are not in a trade or business, it's an investment. Now, what's fascinating about that is until the tax law really changed, we didn't care that much about it. It wasn't that important whether a rental rose to the level of a trade or business in most cases. Now we care about it in two ways. Number one, as you pointed out, this 199A deduction, you can only take it if your rental is a trade or business, and triple nets are going to, have a heavy burden to carry with that. And then second, in the opportunity zone world, right? An opportunity zone business has to conduct a 162 trade or business as well, which means there is some concern, and the latest regulations kind of supported this concern, that if in your opportunity zone investment you simply build a giant building for Walmart and rent it to Walmart on a triple net basis, you will be treated as not conducting a trade or business, and we would disqualify you from opportunity zone incentives. So we're all scrambling to figure out, okay, does every triple net lease not qualify? I mean, what if it's triple net, but you're very actively engaged in the activity as the owner? Or what if, maybe the tenant is on the hook for any internal maintenance repairs, but you as the landlord are on the hook for any, repairs on the outside of the building? Will that make it a not triple net lease? We don't know the answer. And people often say, well, how can you not know the answer to that? And I just have to remind you that until recently, we did not care. It didn't matter, right? If it mattered, we would have had the answer to this 50 years ago. Like if a rental had to be a trade or business before you could take depreciation deductions or something like that, we would have known, 50 years ago how every type of rental fits into the trade or business. But we didn't care because it didn't matter. Now it matters in a big way. And so trust me, I have plenty of clients that own real estate empires, and all of those buildings are rented on a triple net basis, and trying to sit down to them and say, oh, you don't get this 20% deduction because they think you're not in a trade or business. And they say, are you kidding me?
Yeah, they're pissed.
2,500 hours a year. It takes me 2,500 hours a year to manage all these properties. I'm always interviewing tenants and overseeing remodels and, just doing, busy day in and day out dealing with tenant needs. How can you say I'm not in a business? And so we've got this disconnect, I think, between what the IRS thinks a triple net lease is like for the real estate owner and what it's really like in practice. And it's going to take some time. I mean, I've heard some rumblings from Capitol Hill that they may, take a more liberal view towards triple net lease, particularly in the opportunity zone space. But we're going to need, some time to sort through all this and figure out who's in and who's out.
But so two examples, and for the listeners and different clients I work with, trying to figure out, okay, how would I structure this to be safe or be more conservative? Like I have a group of clients who all they buy is absolute triple net deals where they don't have to do anything. They're fast food deals, absolute net, Dollar Generals. They literally, own 20 properties where maybe they pay a tax bill here and there, and they don't ever have to go to the property. They're leased for 15 or 20 years. Just that, I would say that's an unsafe, right? You probably couldn't get away with somehow coming up with 250 hours worth of work.
And don't forget, you can't use that 250-hour safe harbor if it's defined as a triple net lease anyway. So that's, you throw that out right away. That Notice 2019-7 specifically says this 250 hours does not apply to any property rented on a triple net basis. So your true triple nets, where you're just collecting a check once a month, they're going to be, it's going to be really tricky for them, one, to get the 20% deduction, and two, for those types of leases potentially to qualify as opportunity zone investments.
So I had a client on the flip side. I had a client this spring who was in a 1031, and they were concerned about getting the 20% deduction. So they bought a couple double net properties where they actually have to hire the landscapers, hire the snow plowing, hire any repairs. The tenant, in effect, would pay for that. They can get reimbursed under the lease. That's kind of the vagueness of triple net. Where is it financially triple net, or is it like effort, triple net, where you don't have to do anything? And so they bought a couple of properties where they had to be involved, and they thought, they think they can easily do 250 hours worth of work on those properties, document the work, and then to be safe, they bought a piece of land under the same corporation or partnership that they're going to develop and be, actively be doing construction and marketing it and managing it and whatnot. So they would you say that's a good conservative approach?
I would, but I would also say that, everything you just said to me just frustrates me to no end as somebody that, again, studies and writes about tax policy, because good tax policy should not do this to people, right? I mean, it shouldn't force you to go out and buy investments you otherwise might not have purchased or whatever it may be, strictly because you want to meet this fairly arbitrary and misunderstood definition in the tax law of what it means to be a triple net lease, particularly when, again, yes, there are some triple net leases where the landlords are not involved at all, but there are also triple net leases, again, where the landlords are heavily, heavily involved. And so it just frustrates me that so much of the new tax law, because it was cobbled together so quickly, again, is making taxpayers act in ways that, number one, they may not have otherwise acted, and two, right, may not be particularly useful if 4 years from now the corporate rate has been jacked back up to 28% and 199 Cap A has been completely repealed.
Right. It goes back to what you said earlier, is that it's always in flux, and you have to, it's not only what the rules and regs are today, but where you think they might be in 3, 5, or 10 years.
Absolutely. Do you know how empty a gesture it feels like for me to travel around the country as I do, teaching 199 Cap A to law firms and accounting firms, and to know that, just about the time we finally get a handle on what this law means, it's either going to be repealed or it's slated to sunset at the end of 2025, like the rest of the new tax law on the individual side. So it's exceedingly frustrating.
Oh, okay. I didn't know there was a sunset on that either. Okay.
Yes. So the new tax law, completely fascinating. To comply with the fiscal constraints of the budget reconciliation process they used, the bill could not add to the deficit beyond 10 years. Now, we know for the first 10 years, it's going to add $1.5 trillion to the deficit, but it can do that. It just can't add to the deficit beyond 10 years. Well, the bill was running into a problem with that. It was adding to the deficit beyond 10 years. Now, there's a right way and wrong way to address that. The right way would be to go back to the drawing board, reconfigure your bill, and make it work in a way that doesn't add to the deficit beyond 10 years. The wrong way is what they chose. And what they did is they just drew a line in the sand, and more or less every individual provision, from the lower ordinary rates to the doubled standard deduction to this new 199 Cap A to the doubled estate tax exemption, all of it, when the clock strikes midnight on December 31st, 2025, like Cinderella's carriage reverting back into a pumpkin, it will all just expire and the law will reset back to where it was in 2017. So that's the backdrop. This is what I meant before about how volatile it is. That's the backdrop against which we are operating, where, the clock is ticking. Now, why did Republicans do that? Well, like I said, they had to comply with these fiscal constraints, but they assumed they would retain control of the House and the White House and Senate and simply make those provisions permanent. Well, that ship has already sailed because, right, the Democrats have taken over the House. And so that means unless Republicans take it back in 2020, we are working in a situation where these new laws, like 199 Cap A, the clock is ticking. And at the end of 2025, they're just going to be gone.
So Tony, does it make sense for people? I mean, I'm sure it depends on how much income they have, and what their basis is and whatnot. But does it make sense for people to get into, as I think your newsletter is called, the nitty gritty of like these nuances, or does it just make, because it's sunsetting, or because the time is already ticking and elapsed and we don't know what's going to happen? Does it make sense for them to do all these specific tax planning and really warn it? Or does it make sense just to have a more broader kind of general tax plan and not try and maximize the tax code as much, or take maximum advantage of the tax code?
What I always tell people, I quote, Walter White from Breaking Bad, where he just says, tread lightly. And that's what I say. Like, look, understand the new law, appreciate where we stand today, but before you undergo some seismic shift in your business structure, and we've seen that, we've seen people say, man, I've been an S Corp for, 20 years, but now that C Corp rate is 21%, I'm going to jump over and become a C Corporation. Okay, you have every right to do that, but trust me, if Democrats win the White House in 2020 and take back the Senate, that C Corporation rate is not going to be 21%. It's going to be 25, 28% in the blink of an eye. And so it's just so hard because people always want to react instantly to changes in the tax law. But this is different this time around. This was not a bipartisan agreement, right? It was one side and the other side, if they get their chance, right? Think about it. The last time we had one-sided tax law using the reconciliation process was the passage of Obamacare. And so what has every Republican candidate since then said they would do if they get elected? Immediately repeal Obamacare. And that's the way the Democrats are going to approach the tax law. And so, unfortunately, you still have to learn the ins and outs. If you want to make an opportunity zone investment, you can't say, well, I'm not going to pay much attention to it because it only lasts till 2028. Or if you want to claim a 199A deduction, you can't say, well, I'm not going to learn much about it because it's going to expire. You still have to learn this stuff. But before you go making big changes in your business structure, you really do have to give some thought to, where do I think the law is headed? And is it headed to a place where what I'm doing makes sense?
Okay, great. Those are great tips, great points. All right, so Tony, changing gears a little bit, moving from 1031 to opportunity zones. If we go back and use our example, let's just hypothetically say it was a $4 million sale and someone was considering either a 1031 or an opportunity zone. Their basis was zero, and we said, okay, they're roughly speaking, their capital gain total tax bill would be $1 million. Obviously, on a 1031 exchange, they have to go like-kind property into real estate and trade into another property, follow the 1031 rules. They have to use the full $4 million or more to avoid any taxable boot. And they don't have to pay any tax, and they can just keep deferring the tax indefinitely, like we've talked about. Or on the flip side, someone, they're at the golf club and someone says, oh, there's this great new, loophole I've heard people say in the Tax Cuts and Jobs Act called Opportunity Zone. People are going to make a killing on it and they're going to make tons of money, but also help, underserved communities and drive capital to where it's needed. And so you can feel good about your investment. Also, what's the difference? And again, I know the difference, but I'd like to hear it, how you would tell your client those two different differences using that example.
Yeah, sure. I think when you're contemplating a 1031 exchange versus a opportunity zone incentive, I think first things first, the difference is to take a step back, ignore the tax consequences, and say, okay, with an opportunity zone, my hand is forced. I have to invest in one of these designated areas.
Right.
Is that an area that I'm comfortable with? And do you know how many conversations I've had with clients where I said, hey, we got this new incentive in the law, allows you, if you have a gain, to potentially defer a gain till 2026, only recognize 85% of the gain, and then ultimately after 10 years pay no tax on that new investment. But to do it, you have to invest in an opportunity zone. And they say, well, what is that? And I'll say, okay, here's some examples in our neighboring areas of what are opportunity zones. And they look at me and say, it's not for me. Sorry, not for me. Like,
are you crazy? Yeah.
Yeah, like I'm comfortable in this zip code, and that's about it. So that's the non-tax consideration. But if you've decided, that you're willing to do an opportunity zone, it offers, two real advantages over a like-kind exchange, and then in my mind, one disadvantage. The absolute biggest advantage to a opportunity zone investment is that, unlike a 1031 exchange, you can take cash off the table. And so if you have, the best illustration of that is, again, if you have $1 million of basis and you have property worth $4 million, if you want to do a 1031 exchange, as you just alluded to, right? If you don't want to pay any tax, you have to take back a building worth $4 million. If you take back a building worth 3.5 and get $500,000 of cash, well, you've got to pay tax on the $500,000 of cash. So you cannot have your cake and eat it too in the 1031 context, right? If you want to pay no tax, you got to get back just bricks and mortar, no cash. But with an opportunity zone incentive, to defer the gain, you don't have to invest all the proceeds into an opportunity zone. You just have to invest the gain amount. And so if you've got basis of $1 million and you sell for $4 million and you've got $3 million of gain, you can defer that $3 million by investing it into an opportunity zone, but you sold the thing for $4 million. So that extra $1 million, you can just go blow it on a speedboat or take it to Vegas or do whatever the heck you want to do with it. But
so it's not the actual perspective. So in an opportunity zone, it's not the tax amount that you have to reinvest; it's the actual gain amount. So if the tax was $1 million, but the gain is $3 million, for example, you have to invest the $3 million into an opportunity zone.
Well, let's just be careful with the words have. You don't have to invest the $3 million, but any gain you don't invest, you'll pay tax on permanently. And so, there's a lot of flexibility there. If you have gain of $3 million, hey, you could say I want to invest 1.5 of it, and put the other 1.5 in my pocket. Fine. You'll get to defer 1.5. It's not an all or nothing thing. You can defer as much or as little as you'd like. So that's advantage number one. Advantage number two is when let's be honest, right? How is most real estate held in this country? It's in partnerships. And partners, like anyone else, they break up, they get angry, whatever it may be. And so sometimes you could have property in a partnership, and the partnership wants to dispose of that property. It's appreciated. Somebody's interested in it. But, maybe two of the partners say, I want to do a 1031 exchange, and one of them says, I don't. Your hands can really be tied there. You have to be very proactive with your planning, because you can't, again, just kind of divvy it up and say, well, two of them will get 1031 and one of them will just get their cash. Doesn't work that way. The partnership would have to do the 1031 exchange either all in or all out. And so you really would have to be proactive, over a year in advance if you knew you wanted to accommodate all partners involved and give some deferral and some not. But opportunity zones just take that out of the equation, because an opportunity says, look, a partnership that owns property can just sell it for cash, and it can decide what it wants to do. It has two choices. One, if all the partners are on board with deferring, or even if they're not, and the partnership forces their hand, the partnership can simply take, the gain amount and reinvest it at the partnership level. Or if some partners want to do, an investment and some partners don't, great. The partnership can sell the property, pass out the gain to the partners, distribute out the cash proceeds, and let each and every partner make their own decision on what they want to do. Do they want to defer, put it into an opportunity zone, or do they want to take their cash and run? And so that type of flexibility is not generally available in a like-kind exchange. So that is very, very nice when you have multiple partners in a partnership and they might disagree on what they want to do next. But of course, it's not all good news, right? There's one downside, and the downside I've kind of made reference to several times in our conversation. But if you do a 1031 exchange, that deferred gain is not going to come home to roost unless you eventually trigger it by selling the replacement property, right? But
in this example, in 2026, there was $1 million of tax deferred that has to be paid in 2026, correct?
So the downside with an O-zone, unlike the 1031 exchange, is you can, defer gain today by investing in an opportunity zone, but the longest that gain can be deferred is 2026. And there's two problems that come with that. Number one, I referenced earlier that you can take cash off the table if you invest in an opportunity zone. I said, you could blow it in Vegas. Well, you can't, because you have to take some of that cash and set it aside, because the tax bill is coming due in 2026. And the second thing, and I've already beaten this point up quite a bit, is you are at the mercy of what that tax rate is in 2026.
Oh, it's at that rate. It's not at the rate today. Ooh, okay.
Yeah, so that's the beauty of 1031. You defer gain today, you wake up in 2026, you don't like the rate, you just simply don't liquidate your investment. But if you invest in an O-zone today, doesn't matter if you don't like the rate in 2026, right? That deferred gain is coming home to roost. Now, if you've held the investment for 7 years by 2026, then only 85% of the deferred gain will come home to roost, but still, you're going to pay tax at whatever the rate is in 2026 on that 85% gain. And if we're under the second term of President Sanders or President Warren, right, who knows what that rate could be? It could be 50%.
Basically, you've made your decision today.
Yeah, you've made your decision today, and you've got to live with the consequences come 2026. Absolutely.
Okay. And in practice, are you seeing people set up like a sinking fund to pay that tax in the future, or they just have a liability they know they have to fund?
Yeah, I wish I saw more people in practice setting up a sinking fund, but I am certainly trusting that they are aware and understand that that tax bill is coming home to roost in 2026 and planning accordingly.
Okay. And then, another misconception I've seen on the opportunity zone legislation, people contact us about some of the work we're doing in opportunity zones, and they think they have to invest in a fund or in our fund and buy shares or units, whereas a lot of people don't know that they could actually self-elect to make their LLC or whatever their entity is be an opportunity zone fund. Can you go into that?
Yeah, a great example, right? So you have people that might sell stock they hold right now for a big gain, and they say, I don't want to pay tax on that big gain, but I also don't want to give much thought to how I avoid paying tax on that gain. So I'm going to go to one of these syndicated opportunity funds that have been set up, and they've shown me the numbers, and I'm going to get a nice rate of return, and so I'm going to just hand over my money to them and let them handle everything. Absolutely, you can do that. And I had a client from California, call me a couple months ago, and that's what he was leaning towards doing. And then he called me one day and said, well, I don't know if I want to do that. I think I want to engage my own projects, right? I want to buy old rundown houses, maybe one or two at a time in these opportunity zones, renovate them, and then sell them off within these funds, and then take the proceeds and buy more houses and more and more and more of it until I hit the 10-year holding period. Can I do that? Do I need anyone's help, or can I just set up my own fund? And the answer is absolutely you can. And so you can form a new partnership or new S corporation and simply self-certify as being one of these qualified opportunity funds. And of course, there's some standards you have to meet, but you can do that. Or like this client did, he already had an existing entity that had sold all of its assets, giving rise to the gain that he now wanted to invest. And he said, well, why bother setting up a new entity? I will just use this, and on my next tax return, fill in this form 8996 and tell the IRS as of whatever date, he was going to put the cash in, I am a qualified opportunity fund. And so, yeah, that is definitely one of the big misconceptions, is that it's like this crazy complicated type of entity that has to be formed, or this, thousands of partners syndicated partnership. It doesn't have to be that. It could just be you and your spouse. You form an LLC. You drop your dollars into it, and you go about doing whatever it is you want to do with those gain dollars, as long as it complies with the opportunity zone rules.
And just for clarification for the listeners, something we've kind of touched on, but one of the other benefits of opportunity zone legislation is it doesn't have to be like kind to like kind or real property to real property. You can zigzag, or you can go from art or stocks to real estate to other, essentially any, and I want to make sure I say this correctly, but any a capitally appreciated asset that you sell, you can trade into an opportunity zone asset and take advantage of the program, correct?
Yep. Yeah, you're 100% right. And it's really funny that you say that, because when I was speaking to you earlier and I was talking about the differences between 1031 and O zones, I said, there's two advantages and one disadvantage. And immediately I thought to myself, I shouldn't have said that. There's actually three advantages. And the third advantage is the one that you just referenced. When we do a like-kind exchange, we have fairly stringent like-kind requirement rules, right? So no, you cannot swap, your Facebook stock for a residential building, right? You can't do that. But from a opportunity zone incentive, as long as the gain that you ultimately want to defer is treated as capital gain, which means it could be the sale of a building, it could be the sale of Facebook stock, it could be the sale of raw land. You can then take that and put it into an opportunity zone. And we keep referencing that an opportunity zone investment, will be some type of real estate, but remember, it certainly does not have to be.
Right.
You could, for example, sell a residential building, take the gain, put it into an opportunity fund, and use the opportunity fund to start up a computer software business. I mean, there is absolutely zero rule that requires that, they be identical type activities that you invest in before and after. And so that is certainly a level of flexibility we don't have in the 1031 world. I mean, we have to go through all these steps of 1031 to look at, bunch of case law and say, I don't know, is this like kind? Is it not like kind? Well, with opportunity zones, you have other requirements you have to meet, but you don't have that hanging over your head. So you could sell your Facebook stock and then invest in a building, or you can sell a building and invest in a operating business.
Have you heard much rumbling that some of the way that legislation was written, or that's not like kind, was that I've heard people say it's a land grab where people who own a lot of equities in the stock market, they're just pumped. Stock market's just pumped, and it's a way for them to take all their winnings, or essentially chips, off the table, and then defer tax and move. So like people can't sell stock and do a 1031 exchange, obviously. So, but this way they could actually move all their winnings from stock gains over the last 10, 12 years and move it into real estate or other types of startup ventures or other companies. Have you heard people kind of rumbling about that at all?
Yeah. So now, you're starting to touch on the criticisms of the opportunity zone incentive. And if we were going to go through all the criticisms of opportunity zones, we might need another 2 hours on the podcast because it is going to be a very fascinating case study to see, does this achieve the intended result, right? Is this something where people truly have a philanthropic motivation to improve, these low-income areas around the country? Or, like you said, are they going to do the bare minimum necessary to further gain, or even just go through, careful structuring to conduct projects that already would have been done, only now they get a big tax benefit out of it? And so a lot of criticisms about opportunity zones, starting with opportunity zones and the fact that a lot of the zones that were designated are not what we would consider, low-income population tracts, but rather those that are contiguous with those tracts that might be very nice pieces of land. Certainly here in the western slope of Colorado, a lot of Glenwood Springs is an opportunity zone.
Yeah. Which anyone knows it shouldn't be an opportunity zone.
No, it's idyllic, right?
Yeah,
it's an idyllic little town. And so that's one of the problems we're running into. And, the other problem is that in the original legislation, there were going to be metrics that had to be tracked so that we would finally get some empirical evidence, because opportunity zones is not the first time we've had an incentive like this designed to spur investment into low-income areas. We certainly have others like low-income housing and new markets tax credits, but we really wanted to be able to gather data to see, is it working? Does it do what it's supposed to do? And unfortunately, for reasons I'll never fully understand, those metric requirements were dropped in the final legislation. Now, there's been some talk of, trying to bring at least some of them back, but, it's going to be really hard to know in 10 years to what extent opportunity zones were successful in getting people to invest in these low-income areas.
Right. Yeah. So, I've heard a lot of people say that like the original intent was for the impact or, positive change it was going to make. But then if there's no reporting requirements, how do you know, what's actually happening?
Of course. And it seems crazy, but it's true.
In your practice, and I'll give you an example from what we've been doing. I've been talking about opportunity zones. It's July, so we on the podcast and different clients and whatnot. We're probably 8 to 10 months. Loosely been kind of talking about them and having some real serious conversations. And everyone was kept saying, "Oh, the money's going to come. The money's going to come. There's so much money out there." But in my experience, I'm inundated with deals with properties that in opportunity zones. I have hundreds and hundreds of projects that we could do in opportunity zones, but very few people are saying, "Sure, I'm interested, but I'm not really sold on it." What's your experience in your practice?
So I use Twitter quite a bit in the tax community. It's a great way to network, and if you're seeing something that strikes you as being a bit odd, to say, "Hey, has anybody else noticed this?" It's a really useful tool. And one of the funnier things I've seen on Twitter that I think kind of encapsulates what I've been seeing and maybe this is kind of similar to, again, what you just kind of referenced, but I spent some time laying out like this long question about something I had read in the regs and this nuance of, am I reading it the right way, the wrong way? Does it do what it's intended to do? And, somebody on Twitter that just had like, no avatar or whatever, like they just kind of, just responded, and they said, it was really simple, but they just said, no good brain power should be wasted on opportunity zones. Nobody's going to make money on those things. And it was just kind of funny. Now, listen, this person obviously doesn't know much, but that is how some people feel, right? They just feel like, look, you're asking me to invest in a low-income community. You're asking me to hold it for 10 years, no matter, pretty much no matter what happens, which is concerning. And there's just all these other ancillary considerations where I just don't see how it's worth it to us. And so, yes, I'm being met with the same type of reticence you're kind of referring to. And so I think the jury's still out on how much they're going to be used.
And I've seen, deals getting done in the areas, like you said, that where they were already going to be done in the first place, and in gentrification type areas where they were already on the edge of the hot kind of hipster neighborhood. And so all of a sudden the developers are like, sweet, it's another way to attract capital. And those projects are obviously happening, but I'm kind of looking at all the, the rural communities or outlying communities or kind of cities that were kind of left behind after the recession. And people are like, why, like investors I talk to, they're like, why would I want to invest there? Even though there's tax benefits, why would I want to own property there? And it's so, I'm not seeing projects happening. And, I see a lot of people marketing projects, a lot of brokers saying, look, we have opportunities to own deals. This is why it will be a home run, but they're having a hard time selling them.
I think you're right on there. I think that what we're seeing here is a situation where projects that we're going to get done are going to be ones that are getting done. And gentrification is a word that is thrown around quite a bit because the evidence we have of these types of incentives in the past, when they try to influence behavior like this through the tax code, has been that that's exactly what it leads to, is gentrification. And so, I think that's one of the big concerns people have about this new bill is that it's going to take these areas that were on the cusp and bring in new businesses, but the people in the areas aren't going to have the skills to man those businesses, and so they're going to have to bring in employees from outside. Those employees are going to buy up the properties, and before you know it, the old residents that were supposed to have their lives improved are going to be the ones that are out.
Right, and on the flip side, you're seeing, or to prevent that, like municipalities like Boulder, Colorado, for example, just put a hiatus on one of their opportunity zones. They said, look, there's a moratorium. We're not going to approve any new permits. I don't know exactly what the moratorium was, but I know they've put a extended approval process on any kind of development or rehab because they want to prevent those things from happening to make sure it falls under the intent of the law.
Sure. That's what we're going to see a lot of is big questions as far as who's really benefiting here,
And so you've been really generous with your time. I just have a few more questions to kind of wrap it up. And so we don't need to spend a bunch of time on it, but debt and opportunity zones, are you seeing people using debt going in, or is it more of, cash type situation? Like, on a 1031 exchange, for example, if you had 50% debt, 50% equity, you have to match those amounts or use more of each or either to qualify under the 1031 code. What are you seeing how is debt treated in an opportunity zone project?
So there's nothing that prohibits you, once you've put in your tax dollars, your deferred gain dollars into a zone, nothing that prohibits you from taking out money or borrowing money to then go forward with, your development projects or whatever it may be. I have seen people very excited about, wow, so I can go ahead, put in my gain dollars, and then go out and borrow against the property right away and start taking distributions out, right? And people are very excited to do that, but there's some reasons to be concerned there. And without getting too into the weeds, one of the reasons in the new regulations is basically just that it says, like, look, if you're taking out distributions within 2 years of formation of the opportunity fund, the presumption is going to be that your investment was an ineligible investment because this is going to be, kind of what we call a debt finance distribution that's going to trigger gain and cause your deferred gain to be recognized. And so people are very excited about running to the bank after they form their fund and refinancing and then taking out cash proceeds. But they're going to have to be patient because for at least 2 years, you really can't do that without some significant risk. Beyond that, you're going to see debt finance distributions as being the number one way to get money out of an opportunity zone into the hands of the investors. Because remember, investors have to hold their investment for 10 years. They can't just run off and liquidate this whole thing, and investors are going to get antsy. So one of the ways they can kind of work around that is to borrow in the future and then take out a distribution up to kind of the amount that they borrowed without it being a taxable event. But that's going to have to come at least 24 months after formation.
And then they could also use the refinance proceeds to pay the tax in 2026 if needed.
Yeah, absolutely.
Okay,
yep.
Great. So, you hear a lot of people talk about substantial improvement section of the Opportunity Zone Code. And if so using kind of three different examples, the first two are, let's say triple net, or double net, kind of touching on our earlier conversation. One, ground up development. Two, buying an existing building and rehabbing. So those would be triple net examples or double net examples. And then number three, this is kind of a double example of one thing we're looking at with our impact fund is kind of a conservation type easement or conservation type, recreation type program where you buy land and you put it into conservation. And then there's another group doing agriculture, organic agriculture investments. And I asked them about this substantial improvement rule. And where do you draw the line on all those examples of substantial improvement, vacant land, existing building, or minimal improvement to land, like on the third example of conservation or agriculture? Like what constitutes substantial improvement?
Yeah, so this is an area that to me is very lacking in the guidance, and it's a very key term. And I have placed several phone calls to the authors of the latest regulations in the last 2 weeks to try to get to the bottom of something that I know for a fact is bothering a lot of people around the industry, which is just, again, how do we measure substantial improvement? And what I'm getting at here, without, again, getting too into the details here, is any property in an opportunity zone investment that you want to help you qualify for these benefits has to meet one of two tests. Either it's got to be the property's original use in the zone, or you have to substantially improve that property. And so, just classic example, if you buy an old rundown building and want to renovate it, obviously it's not the building's original use in the opportunity zone, because buildings generally do not move. If it's there now, it was there before. And so your only option is to substantially improve it. But to substantially improve it, it says that within any 30-month period after acquisition of the property, you have to spend more to improve the property than you did to acquire the property. And we know a little bit about what that means. If you buy land and building together for $1 million, but the value of the land is $400,000, the value of the building $600,000, you only have to spend $600,000 to substantially improve, because that's the value of the building, not the value of the land taken out of the equation. But other than that, there's so many unanswered questions. For example, the use of the word any. It says during any 30-month period after acquisition, you have to double the basis. Okay, well, can I wait a year, 2 years, 3 years to start improving it? And if I do wait, what is the status of the property while I'm waiting? Is it not qualified opportunity zone property? Is it, there's just a big unknown there. And then it says, strangely enough, that, you have to substantially improve within a 30-month period by doubling the adjusted basis at the beginning of that 30-month period. So what if I bought, a building and did a cost segregation study for it, and I bought it for $2 million, but because of a cost seg study, $1 million of it I was able to put into shorter lived assets and immediately expense.
Mm-hmm.
So if I wait another year, now my basis in that building is not $2 million, it's only $1 million. Do I now have to only spend $1 million over the next 30 months? We need answers to that. And nobody's called me back just yet, so I hope they will, because, I floated this seemingly simple idea by other people in the industry, and they all agree that we don't have an answer to that yet. So substantial improvement, when it happens, what happens until it happens, how we measure it, right? What does it mean to double that basis? What do we do with like soft costs, architectural, engineering costs? What happens then, right? And then, as you said, something like agriculture type work, they do not want you engaging in what they call kind of merely land speculation. And so if you do not put, fairly significant structure on a piece of raw land, it's not going to qualify for an opportunity zone incentive. So we're still looking to really get our arms around what this all means from substantial improvement. But I find it frustrating that we've been through 2 tranches of regulations and still don't have some guidance on a pretty, basic concept.
So it seems like there's a decent amount of risk buying a piece of land if you're not quite ready to build a building on it. The agriculture guy, he said, well, we're, theoretically we could put up a fence and till the land once, and we consider that substantial improvement. Would you disagree with that?
I think there's some risk there. Yeah, I definitely do. I think until we have some more guidance, there's absolutely risk there.
Well, Tony, I appreciate your time, and I'm sure the listeners do also. You've answered a lot of awesome questions and provided great insights for everybody.
Well, Thomas, thank you so much for having me. I mean, this stuff's going to continue to evolve, and as it does, happy to jump back on with you and see if we can make some more sense of it all.
Yeah, I think Jimmy Atkinson, who runs the Opportunity DB podcast, he said it, and I think maybe you or some of the other guests said it, but I think they said with opportunity zones, don't let the tail wag the dog. And that seems to be kind of the overriding theme of like, don't get...
Yeah, I think you're 100% right. People make that mistake way too often.
Okay, great. Well, Tony, where can people read more about your articles or connect with you?
Sure. I mean, everything I write, all my speaking engagements, everything runs through my Twitter account at NittiAJ, NITTIAJ. You can also go to the Forbes tax section. I have a dedicated page there at Forbes.com on the tax section. You could follow me on Forbes to get all my latest articles. And those are the 2 easiest ways to kind of keep up with what I'm doing in the 1031 opportunity zone space.
Okay, great. Well, thanks for being here. We really appreciate it.
Anytime, Thomas. Thank you.
Thanks for listening to the 1031 Exchange Passive Income and Investment Series. To help create, grow, and protect your wealth with 1031 exchanges and triple net properties, visit 1031navigator.com or call 1-866-539-1777. Again, call 1-866-539-1777. Make sure to remember to ask Thomas about our 1031 VIP program. You can put thousands of dollars in your pocket on your next 1031. If you enjoyed the show, be sure to subscribe, rate, and review it where your podcasts are peddled. And if you have a friend considering a 1031, make sure to share this show with them. A referral is the best compliment we can receive. Thanks for listening, and see you again soon. And remember, this show is provided for your informational and educational purposes only. Be sure to check with your accountant, lawyer, and or other tax professionals and advisors before relying on this information. Although the information contained herein is believed to be accurate and reliable, we do not guarantee its accuracy or completeness, and it is provided without warranty. Common sense is the best practice.